Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, and Dan Deming, Managing Partner at KKM Financial. We're here to discuss what VIX term structure reveals about how investors anticipate volatility to evolve, among a host of other things. It's great to see the both of you, as always. Welcome to 2026. Russell, of course, we're a day and a half into 2026 trading days. Anything interesting you could tell us about term structure that could indicate how investors are thinking about volatility
Yeah,
in the market?
yeah, absolutely. And I think as we went through the fourth quarter of 2025, a lot of people were scratching their head over how high VIX was compared to what was going on in the equity markets. Having VIX in the high teens when you're doing an all-time high in the S&P 500 over and over again is it's not something that we're really used to. But VIX has come back to relatively normal levels related to where we are market-wise, but the futures aren't quite buying into it. And what I did was I looked at the futures term structure on the last day of 2024 and the last day of 2025. VIX was in the 16-17 range both times. The January contract was basically in line with spot VIX going into this past year. There's about a 2-point premium right now for January. And then as you go farther out, the term structure continues to be steeper. It's kind of interesting because we were going into a change of administration. So you would think that the markets would be braced for Trump taking over and changing a few things last year. But the market appears to be more on edge right now than it was a year ago.
Yeah.
So
And
and just looking at the term structure, that's the way it
Yeah.
feels.
yeah, and it's interesting, Dan, because you also pointed at the equity volatility. It's a little bit different than cross-asset volatility, right? Particularly metals as an example, where it's
Wow.
seeing increased market vol.
Yeah, for sure. And yeah, the point to what Russell touched on. I mean, the one thing about the January expiration, it is post regular expiration, so we still have a couple weeks before the expiration cycle. So that's part of the reason I think it's holding excess premium. But nonetheless, no matter how you look at it, Russell's right. If you look out past April, you're looking at every VIX future above 20, so you're seeing a substantial premium to cash level that was not necessarily there a year ago. So the market still is on edge looking out over the next quarter or so, particularly when you look at VIX volume as far as the futures market and the demand for the futures. Now, when you look at cross-asset volatility as well, Jill, as you pointed out, I mean, yeah, you're seeing a substantial volatility in the metals markets right now, and typically that does not stay contained. I mean, the markets are pricing in basically the equity markets, what's realized volatility, and kind of what we're seeing unfolded from a day-over-day basis or a 30-year lookout. But nonetheless, even though we're seeing the VIX at relatively low levels coming off of the recent lows, there's still enough of an indication out there in other parts of the market that are indicating the fact that we're seeing substantial volatility in other sectors of the market. And that could be a factor contributing to why we're seeing the demand for the VIX futures remaining elevated.
Yeah. And Russell, you would think over the weekend that perhaps even it would be more of an elevation of volatility because, of course, everyone's talking about oil. It might be good for the stocks themselves, but it seems as if it's largely more of a political concern than a market concern looking at today's action.
Oh, absolutely. It was, I'm one of those guilty Sunday night traders that 5 p.m. Central Time, I'm
Sure.
checking where everything's going to be. I think Dan's probably in the same boat
The
with me.
same.
And needless to say, if I hadn't read any news whatsoever and woke up at 5 in the afternoon Sunday, I would not have realized what had happened overnight, Saturday night through Sunday. Now, if that had happened on a Tuesday or a Wednesday, and it was very possible that it could have happened during the week, because the president did say that they had originally wanted to go 4 days earlier. And, being trader mind thinks, man, if it had been 4 days earlier, that'd have been kind of interesting to watch on the screen. You did see a few prediction markets go. It looked like a couple of people maybe got ahead of the Maduro thing. But as far as the impact on financial markets, it seems to be very light right now. The energy thing, it's going to take a while to get them back up and running. We're all watching Landman, and we know that you just don't flip a switch in these
There
things
you
these
go.
days. And the other area that might end up impacting the financial markets, and one that would be Nasdaq specific, is there are unproven reserves of, I guess maybe that's the right term, of the different type of rare earths that are used in electronics. The thing that China continues to try to dominate and control. And in fact, Maduro's last meeting before he was apprehended was with a large Chinese delegation, and I can only imagine where Earths were part of that conversation. Yeah. But that could turn out to be a positive for the technology sector. But both of those things, the energy, it's going to take a while to get that going, and there's going to be a lot of looking for, can't come up with the right word. Exploration, tripping over that one there, going on in Venezuela. In fact, I saw where a private equity place that focuses on mining already sent a team there today. Yep. People are jumping.
And Dan, I see you shaking your head the whole time.
Yeah. I mean, I'm fat. I mean, I think if, as Russell pointed out, I mean, certainly I was anticipating yesterday. I watched the futures open here at 5 o'clock Central Time, and it's just like you're expecting some kind of big move and just didn't manifest. And, it is interesting that you hear these headlines break, what's going to impact the market, what's not going to impact the market. It's interesting to see how it's being interpreted. I think, certainly the market appears to be more focused right now on this rotation in the market as we enter the new year. Certainly looking at some of the data points coming out this week will be key to the market movement as well. And, I think it is fascinating that, the focus continues to be on the potential for what is already in the pipeline that came out, last year with the AI space, with the technology space. I mean, just a couple of trading days into the year, look at the names that continue to move, and that's supporting the mindset that the equity markets are going to be able to kind of manage, even this disruption that we're seeing unfold, at least at this point, because you're not seeing it. Interest rates are coming down today. Some of the data points showed a little cooling in the manufacturing sector. So the market's really focused on more economic activity here and abroad, more so than obviously political risk right now, maybe to its own detriment. And that's, again, why that volatility in the metal space is something that we're keeping a very close eye on to see if there's a potential for that to bleed into the sentiment in the equity markets.
Yeah. And Russell, you bring up such an interesting point as it relates to the prediction markets. I wonder how much influence that has on the technical and fundamental analysis that goes into the positions that you're going to take, whether it's in the commodity space, equities, income, or otherwise. I don't want to give away too much about last night's episode on Landman and give it away, but the general premise of it was that, 10%, 20% success rate is almost a sexy thing. So it makes you wonder how influential prediction markets are now.
Well, a lot of people that are looking at the prediction markets, and I am thrilled to have the prediction markets as a teaching tool. One of the things that I like to teach in derivatives classes is the odds of something happening as being priced in by the derivative markets. And that's really what the prediction markets are doing as well. We talk about option deltas being, the possibility of the option being in the money at expiration. When you go to some of these prediction sites and you go to do a trade, which will pay off $1, it tells you it's being quoted basically in the percent chance that you're going to be right. So the relationship between these prediction markets and what we've been dealing with in derivatives for decades now, it's a lot closer than people realize.
Yes.
And I have picked up on a couple of small mispricings on Kalshi relative to what was going on in the SPX Fed. Nothing that an institution could take advantage of, but that those markets are directly related to each other.
They are. And Russell, if you want to keep your students engaged, I thought last night's episode was a perfect way to show that example. Not that derivatives aren't sexy on their own, but it really is interesting to see how prediction markets are such a big part of the calculus now. Dan, I'm curious to get your thoughts on that as well, how influential you think
as the evolution continues and, the information becomes more readily available, and certainly the outcomes that they are showing as far as the ability to become a better predictive measure of the potential outcomes and a more precise predictor of potential outcomes is something that continues to evolve. And as Russell pointed out, I mean, really, the Greeks that we've dealt with in the options market for the last 30 plus years, are the evolution of all of this stuff coming together. And now with the technology available to analyze, various potential outcomes, and really fine tune the possibility and the probabilities of prospective outcomes is something that we've been dealing with and managing for years in the options market. So I think it's just the natural evolution of the space, and you continue to see that having an influence on the pricing structure, and the pricing structure becomes more efficient. And I think that's again why at this moment in time, there's no question. When you look at realized volatility running around 9%, the VIX still trading at 14.5, and in theory, it's still too high. But we know that there's other things that get put into that mix that could influence the pricing structure over the next 30 days, 60 days, 90 days. And again, when you get out to April and you look at the VIX future spread relative to the VIX cash, that's very substantial. So the market is very concerned about a couple of possibilities in the next quarter that could impact the pricing structure in the equity markets, which therefore would lead to higher levels in the VIX.
All right. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.